In today's episode, we'll break down two important stories. First, what's behind India's state discoms recording a profit, and then India finally pricing banking risk. Welcome back to the Daily Brief by Zerodha, where we cut through the noise to help you understand what's actually happening in the most important stories from business and markets. I'm your host Akshara, and today is Tuesday, 17th February. By the way, we did a podcast with Ish Mohit from SOIC to understand India's shipbuilding industry from scratch, why it matters right now, what's driving it, and how to find the right proxies to look at it. Do check it out on our channel. Coming to the first story. If there's one institution in India that carries the reputation of a perpetual money pit, it's the state DISCOM. For decades, these entities have been racked with inefficiency, political interference, and an endless cycle of losses and bailouts. Though the faults don't entirely lie in the DISCOMs themselves, their name is synonymous with poor financial performance. So when the Ministry of Power recently announced that in FY25, DISCOMs had collectively recorded a profit after tax of Rs 2,701 crore, it took us by surprise. On many metrics, DISCOMs seem to have done well. Outstanding dues to power generators crashed 96% in 4 years from Rs 1.4 lakh crore in 2022 to just Rs 4,927 crore now. And the ACS ARR gap, which measures how much it costs a DISCOM to supply a unit of power versus what it earns from selling it, narrowed from Rs 0.78 per unit in FY14 to just Rs 0.06 in FY25. These are remarkable improvements by any means. Perhaps there were some early signs of this. In September 2025, CRISIL reported that state DISCOMs are likely to cut their operating losses by over 30%. And there have been recent tailwinds to support such a change in fortunes. For one, India is about to launch a new electricity policy to revamp our electricity sector, primarily our DISCOMs. And in the past few years, we've introduced many policies to improve the finances of DISCOMs. But there's always a but. As we've covered in our primer, DISCOMs have a history of cosmetic turnarounds that mask deeper structural fragility. So we can't help but ask, how much of this profit is real and how much is a paper gain? Let's start with one of the most persistent problems in India's power sector, DISCOMs not paying both power generators and power transmission companies. So for years, DISCOMs would buy power from generators, both state-owned and private, and then delay payments for months, sometimes even years. By 2022, outstanding dues to power producers had piled up to Rs 1.4 lakh crore. But this wasn't just a DISCOM problem. It cascaded through the entire value chain. DISCOMs got paid late by consumers, which trickled down to generators. Generators, meanwhile, couldn't pay coal companies, and the whole system groaned under a mountain of unpaid IOUs. So to try and break the cycle, in June 2022, the Ministry of Power introduced the Late Payment Surcharge or LPS rules. This offered DISCOMs saddled with late payments a way out, but with a strict conditionality. The way out was a graduated liquidation schedule where DISCOMs could convert their legacy dues into EMIs. And the payment timelines were scaled by the size of the debt. If, for instance, the DISCOM owed less than Rs 500 crore, it had 12 months to clear up. Those owing over Rs 10,000 crore got 48 months. The underlying condition, though, was severe. If a DISCOM failed to clear current bills within 1 month of the due date, it would lose access to the interstate transmission network. Essentially, some of its lights could go out. 13 states opted for the liquidation schedule, and the results, at least on paper, were dramatic. Outstanding dues to generators fell 96%, from Rs 1.4 lakh crore in 2022 to just Rs 4,927 crore by January 2026. Payment cycles, it seems, improved from 178 days in FY21 to 113 days in FY25. But these improvements came with a massive caveat. These dues didn't disappear because DISCOM suddenly started earning enough cash to pay their bills. Instead, they were cleared through a restructuring of their existing debt. See, in order to meet the LPS deadlines, most state DISCOMs financed their payments by fresh 10-year loans. They were taken from two public financial institutions, the Power Finance Corporation or PFC and Rural Electrification Corporation or REC. The interest payments under the new loans were lower than what DISCOMs would have otherwise borne if they were late. And these loans amounted to rupees 1,13,737 crore, covering 81% of the total legacy dues targeted by the LPS rules. In the pandemic, the government had introduced a similar plan called the Liquidity Infusion Scheme. The total borrowing under these two schemes reached approximately rupees 2.52 lakh crore, or 36% of the total borrowings of DISCOMs. And the borrowing is heavily concentrated, with 74% of this debt made up by 7 states: Tamil Nadu, UP, Rajasthan, Andhra Pradesh, Telangana, Maharashtra, and Bihar. What's peculiarly concerning is how these loans were even made possible. The standard financial norms typically cap DISCOM working capital borrowing at 25 to 30% of annual revenue, precisely to prevent taking on too much debt. But the government classified LPS and LIS loans as being additional to these ceilings, effectively allowing DISCOMs to bypass the earlier debt limits. Additionally, many of these loans are backed by guarantees from the state governments, giving PFC and REC the security to lend to them. In essence, this was a debt swap or restructuring where two things changed. One, instead of power generators, the liabilities of DISCOMs were now owed to the PFC and REC, spread out over 10-year loans. Two, the maturity and interest rates of the new loans changed. But this new debt is only limited to clearing what the DISCOMs owe the other entities. It cannot be used for capex. So, Prayas Energy, an energy-oriented think tank, found that in 8 major states, 44 to 86% of total borrowing is now used for working capital instead of upgrading infrastructure. The interest burden from these loans alone consumes approximately 5% of the respective state DISCOM's total expenses. On similar lines, some state governments directly assumed the losses of their respective DISCOMs onto their own books. And this cleans up the DISCOM balance sheet but simply transfers the liability to the state exchequer. Now, besides the LPS rules, another important policy driver that impacted the profits was the Revamped Distribution Sector Scheme, or RDSS. So, the RDSS represents a shift from the older approach of bailing out DISCOMs wholesale. It's designed as a performance-linked program. DISCOMs don't get the money just for existing. So, to access central funds, they must meet specific pre-qualifying criteria like publishing quarterly accounts on time, clearing subsidy dues, reducing transmission or AT&C losses, etc. However, the RDSS doesn't just target DISCOMs. A massive bottleneck that DISCOMs face is that their own state government often delays subsidy payments to them even if the DISCOM is eligible. So the RDSS made a carrot and stick policy for state governments. The only way states can qualify for grants, the policy says, is by clearing their dues to DISCOMs. And the grants are massive, worth over rupees 97,000 crore. The policy had the intended effect. States like Andhra Pradesh, Telangana, Madhya Pradesh, and Punjab cleared nearly all subsidy dues from the past 3 years. And subsidy realization, which is the amount actually dispersed in cash versus the subsidy promised, improved from 97.45% in FY24 to nearly 99% in FY25. This massive injection of the arrears of DISCOMs, formally being recognized as real income, is one of the biggest drivers of DISCOM profit. Now, the RDSS also made DISCOMs themselves operationally better. AT&C losses fell to 15% in FY25, hitting the scheme's target range of 12 to 15%. For contrast, in 2016, AT&C losses were at nearly 24%. Meanwhile, billing efficiency improved to 87.59%. Reducing power theft and billing inefficiency directly improves a DISCOM's bottom line. But this performance does come with two asterisks. For one, as per Prayas, in FY24, states like Maharashtra, Rajasthan, and Karnataka showed renewed shortfalls in subsidy payments. Meanwhile, Andhra Pradesh and Telangana consistently met their arrears. What this might mean is that the initial cleanup of arrears to DISCOMs may just have been a one-time effort to grab grants. States might just revert to their old pattern of promising subsidies to DISCOMs and then not paying them, and that perhaps is why the success of this policy so far has also been uneven across states. Secondly, the recorded profit might mask whether the DISCOM has actually improved operationally. For instance, Tamil Nadu's main DISCOM was only able to record a profit for two reasons. It finally received its subsidy, and the state government assumed its losses. Without those line items, it would still have been in the red. But that being said, this may also paper over problems that are specific and unique to that state and can't be solved easily by central policy. Now, beyond these schemes, there are other nails that poke holes into the narrative of the DISCOMs achieving strong financial health. So let's start with who the strongest DISCOMs were. Much of this turnaround in DISCOMs, it seems, was driven by private operators and not public ones. In the 14th annual integrated rating of utilities, every private DISCOM was seen to have recorded a profit, but nearly half the public utilities listed losses in the books this year. The largest loss this year was that of the Bangalore Electricity Supply Company, or BESCOM. Now, the struggle of state owned DISCOMs also continues because the LPS and RDSs don't address some of the biggest issues weighing them down. Perhaps the biggest among these is power procurement. After all, buying electricity accounts for 70% of a DISCOM's total costs. DISCOMs remain locked into rigid, long term contracts with thermal generators that often require payment for capacity, regardless of whether the power is used. And these legacy contracts force DISCOMs to buy expensive coal based power even when cheaper solar and wind alternatives are available. Neither the LPS rules nor RDSS touch procurement reform. Secondly, there's the tariff problem. Tariff hikes are politically explosive and regulators frequently buckle. Moreover, this differs heavily from state to state. Tamil Nadu, for instance, went 6 years without a tariff revision in the last decade. But without a tariff hike, DISCOMs will find it very hard to repay their dues, which will keep adding up over time. In 5 major states, 40% of outstanding consumer dues are more than 3 years old, effectively bad debts that may never be recovered. DISCOMs have no real power here, trapped between regulators who won't raise tariffs and state governments that won't fully compensate for the difference. It's too early to declare victory. Now, the DISCOM profit is significant and reflects many much needed wins in Indian electricity. But these wins were built primarily on a debt swap, subsidy arrears being cleared, and accounting improvements. Reforms like the LPS rules, RDSS, and so on have been building for years. India is forcing change in its DISCOMs, and that matters. But deeper structural problems like rigid procurement contracts and increasing tariffs remain untouched. Until those are addressed, this profit is best understood as the first milestone on a much longer, steeper road. We go through tons of investor presentations and reports while researching our stories. So we thought, why not compile the best infographics, charts, tables, and slides into one newsletter? That's exactly what we do in Points and Figures, a weekly newsletter we send out every Tuesday. Link is in the description. Coming to the next story. So there's a body called the Deposit Insurance and Credit Guarantee Corporation, or DICGC, which ensures that if your bank collapses, at least some of your money stays safe. It essentially runs an insurance scheme for your money. And in return for that promise, banks pay DICGC a premium. For a long time, this deposit insurance system ran on what seemed like a simple principle. Banks paid the same premium rate for any deposit, regardless of how safely it was run. But that era of flat rates is ending. A few days ago, DICGC announced the implementation of what it called a risk-based premium, or RBP framework, which kicks in on April 1st. Now, we know this sounds like a boring technical change about a random fee that banks pay. The consequences, however, could be profound. This could upend the incentives of India's banking sector, and fundamentally, it makes safety cheaper. That makes this simple fee change a governance reform and a competition reform rolled into one. If you're a regulator, a flat insurance premium is an easy, no-nonsense approach to have. If you're a bank, it's unfair. So to understand why, let's borrow an example from health insurance. Imagine a 40-year-old diabetic smoker who has never exercised and another 20-year-old who runs marathons and treats his health like a job. If both were charged the same for insurance, you would get skewed outcomes. The young marathoner would probably find insurance prohibitively expensive. Even if they did buy it, it would feel like a hefty tax. The diabetic smoker, on the other hand, would effectively have their healthcare costs subsidized. The different charges the two pay are, in effect, by design. Banks work the same way. When every bank pays the same rate, safer banks effectively subsidize those that are badly run. And that might be politically convenient for a while, but over time it skews everyone's incentives. Weak banks don't fully bear the cost of the risks they take. Meanwhile, stronger banks are effectively punished for being careful. Now, India has been aware of this mismatch for years. As far back as 2015, a committee recommended moving to a differential premium system, clearly laying out the fairness and moral hazard issues we currently have. And all of that is finally being put into practice. Right now, every bank pays DICGC 12 paisa for every 100 rupees of deposits it holds. That's much higher than the rate when DICGC was set up in January 1962 of 5 paisa. It's steadily climbed since. The new change, however, does away with that flat rate entirely. The new framework has several moving parts here, but the core is simple. So, under the new framework, India's banks will be slotted into 4 categories: A, B, C, and D. A is the safest, D is the riskiest. The premium a bank pays will depend on where it sits. So instead of a flat fee, the safest banks will get up to a 1/3 discount on the standard 12 paisa rate. Banks rated B and C get a smaller discount, and banks rated D pay the same. That is, the framework isn't increasing the burden on riskier banks by increasing their premium, but it's rewarding safe ones for their responsible conduct. So, how does DICGC decide who goes where? First, it places the banks in one of 2 tiers depending on its size, and then it judges you according to your category. Tier 1 covers scheduled commercial banks other than RRBs. These banks will be evaluated using a mix of indicators, including what's called the CAMELS framework, which is a global method that evaluates banks across a range of parameters. RBI already uses this framework for supervision, and now it'll also influence insurance pricing. Tier 2 covers regional rural banks and urban and rural cooperative banks. Here, CAMELS will still matter, but the quality of governance gets extra weight. After all, in smaller, locally run cooperative banks, weak governance is often where financial trouble festers. So the regulator is effectively saying, if your governance is shaky, your insurance bill should reflect that. There's also an additional vintage benefit. This is an extra discount given to banks for long periods of good behavior. So if you've been a good bank for 25 years, you get another 25% discount on your premiums. As soon as something goes wrong, though, it resets to 0. The effective premium that banks pay then will be the card rate of 12 paisa with a discount for both how safe you are and how long you've been safe for. If a bank that gets A rating, which is 33.33%, and hasn't been a problem for 25 years, which is 25%, it effectively gets 50% off on the 12 paisa rate card. Now, there are a lot of carve-outs for this rule. There are some banks, like local area banks and payment banks, that don't get a rate cut simply because there isn't enough data. There are others that don't get a discount, including urban cooperative banks under RBI scanner, and DICGC has the discretion to cancel your discount if there's an adverse deployment. So this is a huge relief for banks that are already well capitalized, well run, and structurally low risk. Here's a rough back of the envelope example. In FY25, SBI paid over Rs 5,400 crore to DICGC as insurance premium. Under the new framework, assuming it gets the maximum discount, that bill will be halved. It's a saving of Rs 2,700 crore, more than the lifetime profits of many smaller banks. And that gives SBI a massive buffer. In FY25, commercial banks contributed 94.72% of the DICGC's premium collections. Cooperative banks contributed just 5.28%. But when it came to claim payouts, it was the opposite. As of March 2025, DICGC had settled cumulative claims of Rs 10,954 crore for 389 cooperative banks. It had just given out Rs 296 crore for 27 commercial banks. That is, for years, India's stronger commercial banks effectively funded a system to bail out cooperative banks. So if large commercial banks now qualify for lower effective rates, that cross-subsidy weakens by design. But that's only half the story. There's a more uncomfortable angle to this. So for weaker institutions, especially those already dealing with governance issues or thin balance sheets, this framework effectively adds pressure. If they don't qualify for discounts, they sit at a permanent cost disadvantage versus stronger peers. And that puts them on the back foot while competing for deposits and makes it less likely that they make a profit. Now, this can push them in 2 ways. Ideally, you have the best of all worlds. Banks clean up, reduce risk, tighten governance, but equally, they might take on more short-term risk to protect earnings. Both outcomes are plausible depending on how tough and consistent supervision actually is. If banks think they can get away with more risk, chances are they'll try. So the big question is this: can this new regime actually cure moral hazard? So, moral hazard is when someone takes extra risk because they don't bear the full downside, usually because there's a safety net. Think of a CEO that's promised a golden parachute if they're ever fired and therefore is cavalier with risk. The argument here is that a flat fee creates such a moral hazard, allowing poorly run banks to work with impunity. The new framework then should do away with it. So, is that actually the case? To be clear, risk based pricing definitely nudges incentives in the right direction, but sadly, a simple price change doesn't guarantee better behavior either. The big problem here is that you can't price what you can't see. Banking, by its nature, is opaque. A bank's risk isn't always visible in real time. Numbers can be delayed, problems can be hidden, things can stay bad for years until they blow up. So the DICGC's ratings are essentially given by looking in the rear view mirror, and by the time you realize that a bank was taking too much risk, it might already be too late. This is why pricing can't do the job alone. It has to be backed by tight supervision and quick action. If the rating model lags reality, or if governance deterioration isn't caught early, the new regime, despite looking neat on paper, will underdeliver in practice. That was the experience of the FIDC, which is the American equivalent of the DICGC. The US used to have a similar flat fee before it moved to risk based pricing in 1993. But that wasn't a silver bullet. It had to spend decades recalibrating its framework, adding adjustments for large and complex banks. India should assume the same path, that it'll take years of refinement to make the system useful. Right now, all we have is a foundation. Now, there's a third possible outcome of weaker banks feeling the squeeze of higher prices, especially if they can't fix governance or improve asset quality fast enough. So instead of dramatic failures or hidden risk, this can show up as consolidation. Without a clear path to competitiveness, banks may seek a quiet exit through a merger or acquisition. And the RBI has been nudging the system in this direction anyway. Consider, for instance, the voluntary amalgamation scheme for UCBs launched in 2020. In fact, that kind of consolidation may even be the point. Beyond the pricing changes, there's an interesting design choice that the new framework comes with. A bank's rating is secret, and DICGC has said a bank's risk category will be shared only in strict confidence with its MD or CEO. They can't disclose their category publicly, they can't use it for marketing. In fact, they can no longer even disclose the exact premium amount they pay in the notes to accounts, like we saw with SBI. They'll only make a generic compliance disclosure. Fundamentally, the regulator wants to avoid a self-fulfilling panic. Imagine a bank is tagged D, which then makes depositors jittery, precipitating a bank run. A bad rating then could trigger the very crisis the system is trying to prevent. But that comes at the cost of less transparency for the market. Depositors and analysts don't have a potentially useful signal about the risk underlying a bank. It's too early to say how these reforms actually work out for the banking sector. In fact, the regulator itself isn't sure yet. The new framework will be reviewed at least once every 3 years. But there are a few signals you can watch out for. Watch for pricing pass-through. Do well-run banks start giving better deposit rates and more competitive lending terms? If that's the case, look for deposit share migration. Do deposits slowly drift towards stronger banks because the funding economics improve? On the regulator side, keep an eye on DICGC's fund adequacy. Does it improve, stay stable, or come under pressure once differential pricing kicks in? Does collecting less from the safest banks leave a hole that matters? Together, this should give you a sense of how the framework evolves. Now coming to the tidbits. Kerala has approved India's first full graphene policy to attract investment and become a global hub for graphene research and manufacturing. It's backing this with incentives like a 50% lease subsidy for units in government parks. The state also plans a graphene industrial park in Palakkad and a Rs 200 crore digital innovation center. Coming to the next tidbit. The Union Cabinet has cleared a Rs 1 lakh crore urban challenge fund to push big-ticket city infrastructure. The centre will fund 25% of project costs, but only if cities raise at least 50% from markets, forcing more private capital and reforms. The government says this could unlock rupees 4 lakh crore of total urban investment over 5 years. Coming to the final tidbit. Indigo plans to hire over 1,000 pilots after a December 2025 crew shortage led to 5,000 plus flight cancellations in a week. The problem worsened after tighter DGCA duty and rest rules, and regulators said Indigo hadn't scaled hiring or training fast enough. Now the airline is expanding training and adding buffers like more standby crew and schedule slack. That's all the news I have for you. Thank you so much for watching, and see you in the next one.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.